In 2016, global silver mine production hit 900 million ounces. The price that year averaged $13.30 per ounce. By 2024, 8 years later, production had fallen to 820 million ounces, an 80 million ounce decline, nearly 9% less silver coming out of the ground. And the price? Over $31 per ounce, more than double. Think about that for a second. The price doubled, and production fell. That's not how markets are supposed to work. When prices rise, supply should increase, producers should ramp up, mines should expand, new projects should launch. That's basic economics. Except it's not happening, and it's not going to happen, because silver mining faces structural problems that higher prices can't fix. Problems so fundamental that even if silver hits $50, $75, or $100 per ounce, production might barely budge. Or worse, it might keep falling. Let me show you exactly why silver miners can't keep up with global demand. Not won't, can't. The geology is failing. The economics are broken. The timeline is impossible. And the entire industry is built on a byproduct model that makes silver production a hostage to other metals prices. This isn't a temporary bottleneck. This is a permanent constraint. And once you understand why miners can't respond, you'll understand why the supply deficit isn't closing, why inventories keep draining, and why the market is setting up for a shortage that could last years. Start with the most obvious problem. The ore is getting worse. Silver doesn't exist in pure form underground. It's mixed with rock. And the ratio of silver to rock, that's called the ore grade. The higher the grade, the more silver per ton of rock you process. The lower the grade, the more rock you have to move, crush, and refine to get the same amount of silver. And grades are collapsing. According to Metals Focus, ore grades at primary silver mines have fallen approximately 22% since 2005. That means miners have to process 22% more rock just to maintain the same silver output. More rock means more diesel fuel for trucks, more electricity for crushing and grinding, more chemicals for processing, more labor, more cost, all for the same amount of silver. The U.S. Geological Survey reported that average silver ore grades declined approximately 30% globally over the past decade. That's not a small shift. That's a structural deterioration. The high-grade deposits, the easy silver, it's already been mined. What's left is lower quality, deeper, more difficult, more expensive, and it's not getting better. As mines age, grades continue falling. The best ore gets extracted first. What remains is the marginal material that wasn't economic at lower prices. Now it is, but barely, which means there's no buffer, no room for cost increases, no margin for error. Take Mexico, the world's largest silver producer. Mexico supplied 186 million ounces in 2024, roughly 23% of global production. But several major Mexican mines are approaching end of life. San Julian closes in 2027. Mercedes, Bolañitos, San Rafael, Dolores, San Dimas, all scheduled for closure or significant production declines by 2025 to 2026. New projects like Terranera and Media Luna are coming online, but they're adding maybe 5 million ounces combined. That doesn't replace the 20 to 30 million ounces being lost from closures. Mexico's production is projected to decline 13% by 2029. That's a loss of 24 million ounces annually from the world's top producer. Peru, the third largest producer at 111 million ounces, faces similar issues. Major mines like Cerro de Pasco and Andechagua are closing. Social unrest has disrupted operations repeatedly, and ore grades at key mines are declining. Peru's output is expected to fall 5 million ounces by 2030. This is the pattern globally. Existing mines are depleting, grades are falling, production is declining, and new projects aren't replacing what's being lost. Now, let's talk about the economic trap. Even when prices rise, miners can't respond because costs are rising faster. The all-in sustaining cost, AISC, to produce silver has gone from approximately $9.50 per ounce in 2010 to $26.86 per ounce in 2024. That's a 183% increase. Why are costs exploding? 5 reasons. First, lower ore grades mean processing more rock for less silver. We covered that. Second, energy costs. Diesel and electricity prices have surged. Mining is energy intensive. Trucks, excavators, crushers, grinders, refiners all require massive amounts of power. When energy prices spike, mining costs spike. Third, labor. Skilled miners are in short supply. Wages have increased 15 to 20% in many jurisdictions over the past 5 years. And mines are often in remote locations where attracting workers requires premium pay. Fourth, environmental compliance. Regulations have tightened globally. Water management, tailings storage, emissions controls all add cost. According to Ernst & Young's Global Mining and Metals Report 2024, environmental compliance costs increased 15 to 20% annually for precious metals operations. That's cumulative, compounding, relentless. Fifth, sustaining capital expenditures. As mines age, infrastructure requires constant replacement. Equipment wears out, pits get deeper, underground operations extend further. All of this requires capital investment just to maintain current production levels. Not expand, maintain. Metals Focus summarized the situation bluntly. Rising production costs have constrained silver supply. Despite higher silver prices, operating costs have outpaced revenue growth, leading to little or no improvement in operating cash flow for silver-focused mining companies. As a result, many silver miners have been free cash flow negative in recent years. Think about that. Silver prices doubled. And miners are still cash flow negative. They're not making money. They're barely surviving. And you expect them to ramp up production? With what capital? How? The economics don't support expansion. Even at $31 per ounce, many primary silver mines are marginal, and primary silver mines only produce 28% of global supply. The other 72%, byproduct. This is the killer. This is why silver supply is structurally constrained. 72% of silver comes as a byproduct of mining other metals. Lead and zinc mines produce about 45% of global silver. Copper mines add another 15 to 20%. Gold mines contribute 7 to 10%. These operations aren't mining silver. They're mining lead, zinc, copper, and gold. Silver just happens to be there. And here's the problem. These mines make decisions based on the primary metal, not silver. If lead prices are weak, lead mines shut down. If zinc prices crash, zinc mines close. If copper economics don't justify a new mine, that mine doesn't get built. And the silver that would have come with it, it never gets produced. According to industry analysts, even significant increases in silver prices are unlikely to influence production plans dependent on other metals. The economics and production plans of these mines are primarily driven by copper, lead, and zinc markets. Silver is a bonus, a credit against costs, but not the deciding factor. Metals Focus put it plainly. If you need more silver for solar panels, electric vehicles, or electronics, you need to convince copper, lead, zinc, or gold miners to increase production. Because that's where 72% of the metal comes from. But those miners aren't increasing production either. Copper mines face declining grades, rising costs, and long development timelines. Zinc prices have been weak for years. Lead mining is flat. The base metal sector is just as constrained as silver, which means silver byproduct is locked in, capped, unable to respond to silver demand regardless of price. This is the byproduct trap, and it's permanent. Now let's talk about the timeline problem. Even if a company discovers a massive new silver deposit tomorrow, even if the economics are perfect, even if they secure financing instantly, how long until that deposit produces silver? 7 to 10 years, minimum. That's the average timeline from discovery to production for a new mine. Discovery, exploration drilling, feasibility studies, permitting, environmental assessments, community consultations, financing, construction, commissioning. Each stage takes months or years, and that's if everything goes smoothly, which it never does. Permitting alone can take 3 to 5 years in jurisdictions with strict environmental regulations. Community opposition can delay projects indefinitely. Financing can fall through if metal prices dip. Political changes can kill projects overnight. According to mining technology, development timelines for new mines typically range from 7 to 10 years. Capital intensity has increased substantially, with projects requiring significantly more investment per ounce of production. And the project pipeline for primary silver mines remains limited, with few large-scale developments approaching production. Translation: there are almost no new primary silver mines coming. The ones in development are small. The big projects are stuck in permitting or lack financing. And even if they all succeed, they won't come online until the early 2030s. By then, the deficit will have consumed another billion ounces from above-ground inventories. Exploration isn't helping either. According to S&P Global's 2024 exploration report, primary silver exploration budgets fell 11% year over year to $556 million. That's a 15-year low. Why? Because silver prices were too low for too long. From 2011 to 2020, silver averaged below $20 per ounce. Companies didn't invest in exploration because projects weren't economic. Now prices are higher. But exploration takes years to translate into production. You can't drill today and mine tomorrow. Exploration finds deposits. Then you need 3 to 5 years of drilling to define the resource. Then feasibility studies. Then all the steps I just mentioned. The exploration drought of the 2010s means there's no pipeline of new discoveries ready to develop. The projects that would be coming online in 2025 to 2027 should have been discovered in 2010 to 2015. They weren't. The industry underinvested. And now there's a gap, a 7 to 10 year gap that can't be closed. Let me show you the numbers. In 2024, global industrial demand for silver hit a record 680 million ounces. solar panels, electric vehicles, electronics, 5G infrastructure, all consuming silver at unprecedented rates. Meanwhile, total supply, mining plus recycling, reached approximately 1.1 billion ounces. Demand across all categories, industrial, investment, jewelry, totaled 1.16 billion ounces. That's a deficit of 150 million ounces for the fourth consecutive year. The cumulative deficit from 2021 to 2024 reached 678 million ounces. That's nearly 10 months of global mine production consumed beyond what was produced. Where did that 678 million ounces come from? Inventories, above-ground stockpiles, vaults, reserves accumulated during previous years when supply exceeded demand. But those stockpiles are finite. They're being drained, and miners can't refill them because production is flat or falling. Metals. Focus projects that mine supply will experience staggered growth, rising to a peak of 856 million ounces in 2027, then plateau. But production from currently operating mines is expected to fall by 2029. Output will become increasingly reliant on successful commissioning of developing projects. And here's the critical phrase. Given the challenges associated with advancing projects through to production, the outlook for silver mine supply is therefore uncertain. Uncertain. That's industry speak for we don't think it's going to happen. So let's be clear about what this means. Industrial demand is growing. Solar installations are accelerating. Electric vehicle production is expanding. Electronics consumption continues rising. These trends are locked in. Governments are mandating renewable energy. Automakers are committed to electrification. Technology keeps advancing. Silver demand from these sectors will reach 700 to 750 million ounces annually by 2027. Some analysts project it could hit 1.6 billion ounces by 2030 if current growth rates continue. Meanwhile, mine supply is stuck at 820 to 860 million ounces. Maybe, if everything goes right. That's a structural deficit of 200 to 300 million ounces annually, possibly larger. And it's not closing because miners can't respond. The ore grades are falling, the costs are rising, the economics are marginal, the byproduct structure is rigid. The timelines are measured in decades. And the exploration pipeline is empty. Recycling can't save this. In 2024, silver recycling reached a 12-year high of 193.9 million ounces, up 6% from the prior year. That's good, but it's nowhere near enough. Recycling added 194 million ounces. The deficit was 150 million ounces. So recycling helps, but it doesn't solve the problem. And here's why recycling has limits. Most industrial silver is consumed. It's used in tiny amounts in electronics, solar panels, batteries, medical devices. When you throw away a phone, the silver inside, maybe 0.03 grams, is uneconomical to recover. The cost to extract that silver exceeds its value. Solar panels lock silver away for 25 to 30 years. And even when panels reach end of life, recycling is expensive. Most panels get landfilled. That silver is gone, not for months, for decades, or permanently. The only silver that gets recycled efficiently is jewelry and silverware, industrial scrap from manufacturing. But industrial applications increasingly use silver in forms that can't be recovered. The technology sector alone consumes silver at roughly 18% recycling rates. That means 82% of silver used in electronics is never recovered. So recycling is helping at the margins, but it's not a solution to a 200 million ounce annual deficit. Now, let's talk about what happens next. Because the market is setting up for something that hasn't happened in silver for 45 years. A sustained supply squeeze driven by physical shortage, not speculation. In 1980, the Hunt brothers tried to corner the silver market. They bought 200 million ounces. Silver spiked to $49 per ounce. Then COMEX changed the rules, forced liquidation, and the price crashed. That was a speculative squeeze, artificial, created by two billionaires with leverage. This time is different. This time the shortage is real. Industrial demand is consuming more silver than mines produce. Above-ground inventories are draining. COMEX registered silver fell from 400 million ounces in 2021 to 47 million ounces by late 2024. That's a 90% decline in deliverable inventory in 3 years. London vaults held over 900 million ounces in 2020. By December 2024, that figure dropped to 827 million ounces, and roughly 551 million ounces of that total backs silver ETFs. It's not available for commercial use. The float, the actual liquid supply available for industrial buyers and traders, is shrinking fast. And miners can't replace it. They're producing 820 million ounces. Demand is 1.16 billion ounces. The math doesn't work. At some point, probably within the next 2 to 3 years, the available supply gets so tight that physical premiums explode. Delivery times extend from weeks to months. Industrial users start securing long-term supply contracts at any price. And the paper market, the futures and derivatives, diverges from physical reality. We saw a preview of this in 2020 during COVID. Physical silver coins were selling for $12 to $15 over spot price because supply chains broke. Dealers couldn't source metal. That premium lasted months. Now imagine that scenario, but structural, not temporary. Not fixable by restarting a mint. Fixable only by years of increased mine production, which isn't coming. That's the setup. Demand growing. Supply flat or falling. Inventories draining. Miners unable to respond. And a market that's only beginning to price in the reality that silver might actually run short. Here's the part that should concern anyone watching this market. The entities that control existing silver supply, the miners with stockpiles, the refiners with inventory, the institutions with massive positions, they're not increasing supply. They're holding, accumulating, positioning for exactly this shortage. Because they can see the same data I just showed you, they know miners can't respond. They know the deficit isn't closing. They know inventories are finite, and they're positioning accordingly. Which raises a question. If miners can't keep up with demand and inventories are draining, who actually controls the silver supply that remains? Who's holding the stockpiles? Who has the power to decide when and if that metal comes to market? And what happens when industrial users realize they are competing for supply with entities that have been accumulating for over a decade? Because this isn't just about miners failing to produce. This is about a market structure where supply is controlled by a handful of players who understand exactly what's coming. And if you want to understand who those players are, how much they hold, and why their positions might be the most important factor in the silver market right now, there's something you need to see. I've got a video on this channel that breaks down who really controls the world's silver supply. Not the miners, not the governments, the entities that have quietly positioned themselves to profit when this supply crisis goes from theoretical to actual. The corporations, the exchanges, the silent accumulators who've built positions so large they dwarf annual production. Watch that next. Because understanding why miners can't keep up is one thing. Understanding who controls the supply they're failing to produce is another. And once you see the concentration, the opacity, and the structural power held by a handful of entities, the silver market looks very different. Miners can't keep up with global demand. The ore grades are falling, the costs are rising, the byproduct trap is permanent, the timeline is impossible, and the deficit is locked in for years. But someone is positioned for exactly this outcome. And they've been accumulating for 14 years. Find out who? Watch the next video.